But I guess in terms of multiples, I mean, it's clearly one of the most expensive stock markets ever by some measures. It's not, and this makes it look like the PE isn't as bad as it was. I guess that would have been 2021 during the kind of the crescendo of bubble 3.0.
Mhm.
But I mean, really, if you look at things like price to sales or the Buffett indicator, which is market cap to GDP, I mean, we're at record levels.
We're giving an outlook for the economy, bond yields, inflation, Fed monetary policy, and which assets you should be positioned in going into 2025. Joining us are co-CIOs of Evergreen Gavekal, a diversified fund with over $4 billion under asset management, David Hay and Jeff Dix. Welcome to the show, gentlemen. Thank you for both.
Thanks, David.
Thank you, David.
Thank-
Good to be here.
Jeff, first time on the show. Welcome. David Hay is a fan favorite. He's been on several times. So it's good to have both of you. You can check out David's last interview with me, link down below, where we talked about valuations and the outlook for stocks. Things have maybe changed following the election of Donald Trump, Trump's win. What is a Trump trade for you? I'll start with David first, and then we'll talk macro with Jeff. David, what is a Trump trade for you?
Well, I guess a month ago buy Bitcoin, right? Or even better, buy Dogecoin. Yeah, it's an interesting question because there has been a tremendous surge in animal spirits, actually even before the election. And I think one of the visuals we have coming up is the betting line on the election, which led us to believe that Trump was going to win pretty handily. And that was not what the polls were saying. So the market really started to discount the Trump trade in September. And the question I would think that's really pressing right now, has it been overdone? Are we in a Trump-phoria type of phase? And I think the answer to that is yes. And I think what's happened to Bitcoin here recently is interesting. And it's been hit pretty hard after just a spectacular run. And I do worry that there's just so much speculation that has returned to the market. It's very reminiscent of what happened in 2021 before the really rough year 2022. And Jeff's got some great slides that I think are a little bit cautionary in that regard.
Well,
that when you have these 2 good years, that you tend to have a payback year. Sorry.
yeah, we'll get to those slides and we'll get to your asset allocation in just a minute. But before we do, I mean, your fund has outperformed your fixed income strategy. So you call that the principal preservation strategy has outperformed the benchmark. Are you still sticking to bonds though in 2025? Is that still your outlook?
Well, there's bonds. Jeff will get into this in a little bit more detail, but there's lots of kinds of bonds. I mean, there's bonds that actually have variable interest rates, which we have previously had. There's very short-term bonds because, as you know, the bond bear market the last few years, really that started in August of 2020, has been one for the ages. I mean, this has been a vicious bear market in long-term bonds. And we fortunately anticipated that and positioned accordingly. I think what's maybe pressing now is if the consensus view of soft landing, no landing is wrong, and frankly, there's evidence starting to accumulate that it might be, then we could actually see a powerful rally in long-term treasuries for a while. But I think the kind of the standard playbook of saying if we're going into an economic slowdown or recession, you buy long-term treasuries and just kind of ride them for a couple of years. I don't think that works anymore. I think the problem is that deficits are so large in the U.S. right now. Jeff's got some great visuals on this. If you have a recession, the deficit's going to go absolutely ballistic, and so will issuance. And you could actually have interest rates rise in a recession. But I think the knee-jerk, or as Jeff Gunlaw calls it, the Pavlovian response would be for a bond rally. And we saw that earlier in the year, and then that really faded. But at this point, we could be setting up for a short-term bond rally.
Okay, Jeff, you have a chart on bond yields later on in the slide deck. We'll get your outlook. Before we get your outlook, let's talk about what's happened so far. Why has the 10-year yield reversed on its initial rally after the Trump victory here?
Well, I think the market realizes with a red sweep, Trump can get through a lot of his policies, which inherently is going to be inflationary. If you look at forward Fed funds rate, it's gone from 2.8 to 3.8. So the number of cuts baked into the market has come down significantly. And what I think that means is interest rates are going to be higher for longer. The policies that Donald Trump will put through are going to be largely inflationary. And so far that's been bad for bonds. However, at this point, bonds do look fairly oversold, and you can still build out really a pretty high quality portfolio on the income side, paying 5 to 5.5%, which we think is attractive for investors that are focusing on income. So I think largely higher inflation, less and fewer rate cuts, but a relatively strong economy.
Are you enjoying the video so far? Well, let me tell you about how you too can come up with viral video ideas, which from my personal experience, I can tell you is one of the hardest parts of being a YouTuber is coming up with the idea. Well, that's where today's sponsor comes in, One of 10. It helps YouTubers like me find their next big idea, titles, and thumbnails in just a few seconds. Take your channel to the next level with One of 10 Idea Generator, competitor tracker, and millions of viral videos, saving you hours of research. It's been rated the #1 must-have tool for any creator by some of the world's top YouTubers, and it's only $49 a month. Click the link in the description down below and use a code DL70 for 70% off, or scan the QR code here to get started this Black Friday weekend only. All right, so on that note, let's talk about the economy. So I'm going to share my screen and show this slide deck here that you prepared for us, starting with your outlook on whether or not we're getting a soft landing or no landing. I think we spoke offline about the hard landing narrative being discarded now with some newer data coming in the last couple months. What are we looking at right now, Jeff? The ISM Services PMI ticking up. What does that signal to you?
Yeah, well, I think it's almost no question we're having a soft or no landing. Q2 GDP was 2.9. Q3 GDP looks like it's coming at 2.8 real. So those that think there's a recession at hand, I think are wrong, quite frankly. This first chart shows the ISM Services PMI. And when you have a reading above 50, you're in expansion. We're at 54.9. There's a new orders component to this index, which hit a 19-month high. That's 59.4. You can see on this chart, the last 3 recessions, you had new orders dipping well below 50, and you had the ISM services well below 50. So, when 75% of the economy is in expansion, I think that points to a fairly robust economy.
Retail sales and the consumer. So I'm getting mixed messages here. On the one hand, yeah, consumer spending, according to retail sales, has been hitting all-time highs, but they're also probably using credit cards a lot more. If you take a look at the level of credit card debt, that's been on the rise as well. So what's going on here?
Well, I think it's just you have retail sales on this chart, and you have household net worth, and both of those are hitting all-time highs. You're right, for sure, David. Credit card spending has gone up. You're starting to see a rise in credit card delinquencies. I think that is focused more on the lower wage cohort, but at the same time, and the next chart shows this, you have real wages that are strongly positive. So with credit card spending maybe a little tapped out here, you're also seeing an inflection with real wages. So that is, I believe, supportive of future spending growth when you have wages growing at 5+%, and a lot of the headline inflation numbers now in that 2 to 3 zone. You have that excess spending ability, and then also this chart just highlights, generally you don't have a recession when household net worth hits an all-time high, retail sales hitting an all-time high, and it's not to say the entire consumer base is strong. We're certainly seeing pockets of weakness, particularly in the lower wage cohort, but generally speaking, I see a strong U.S. consumer base, spending base.
What's interesting is that during 2022, when we had a bear market, household net worth fell, coincidentally with the fall in the stock markets and bond markets as well. But retail sales didn't seem to fall on the same level. Did that surprise you?
Well, I think at that point you had money supply that was still extremely elevated from COVID. So, and also the Fed balance sheet was extremely bloated. The amount of spending that our government did throughout COVID, and not to mention the deficit was still extremely wide or negative, was what kept spending fairly strong. So, yeah, it is a little surprising when that occurs. However, I think it was a function of how much government spending that we did during COVID and even a couple years after COVID.
All right, this
Yeah, I think
next,
Jeff's right about that. But I did want
yeah,
to just chime
sure.
in there a little bit, David, because that household net worth chart is, I mean, it looks impressive, but what's even more impressive is to realize the dollars behind that. So basically, total U.S. household net worth at the end of 2019, right before COVID, was around 100 trillion. It's about 150 trillion today, a $50 trillion increase in household net worth. So, I mean, remember coming out of the global financial crisis, Ben Bernanke was trying to create a wealth effect. Well, this is, like the mother of all wealth effects that we've seen. So it's there's no wonder that, especially for high end consumers who tend to own those assets. I mean, this is part of the societal problem, is that the ownership of assets is very skewed, as we all know. So they say top 10% of households. So it's very much of a tale of two consumers: those that are doing great and those that are struggling. And I think that's why you're starting to see personal bankruptcies rise rapidly, and of course, credit card defaults, auto loan defaults, and so it's a very mixed picture out there.
Well, this next chart may also point to some mixed messaging here. On the one hand, you have the gray line, U.S. average hourly earnings, all employees, total private year to year, year over year percent change. That's slightly ticking up, although the longer downtrend is still in place. And on the other hand, you have real average hourly earnings um, growing in positive territory. Um, yeah, what do you make of this chart? Are living standards improving over time because people are earning more, inflation adjusted?
Well, you had a real long stretch of inflation running above wages, and that was very painful for consumers. That's when we had the interest rates move up significantly in 2022. That's when the Fed funds rate hit 5.5. And that was basically a 2-year stretch where inflation was running above wages. In 2023, that flipped, and it's been that way for 19 months. I think you're starting to see some pressure relieved, but that was a very painful stretch from 21 and 22. So I wouldn't say it's all gravy for the consumer, but at this point, after almost 2 years of positive real wages, I think you've had a little bit of relief for at least part of the consumer with, wages going up at a faster clip than inflation.
That begs the question as to whether or not the Fed will continue to cut rates despite positive economic data. Jerome Powell did say very clearly that he's watching the data for what to do next. So what is next?
Yeah, I mean, it's changed quite a bit over the last 2 months. Like I mentioned previously, the forward Fed funds rate was 2.8 at the end of 2025. So you had 10 cuts baked in before the first 50 basis point cut. Now you only have six. Largely, I mean, overall, I mean, it's going to be somewhat supportive, but less so than just 2 months ago. So yeah, you're going to have rates coming down, but they're going to come down at a slower clip. But you're also going to get some supportive policies on deregulation. So, there's some offsets there, and rates are coming down. And I think largely financial conditions are easing, and they're going to continue to ease. So I think net a positive, but less so than a few months ago. But some of the policies that we're going to see are also pro growth.
How many rate cuts are you expecting next year?
I'd say four.
Okay. This, I guess, ties into the broader global monetary policy picture. Do you think there's going to be major policy divergences between the Fed and its peers?
No, I think it's going to be pretty coordinated in the Eurozone, in Canada, Australia, the UK, even China's easing. I think globally, you're going to see, lower rates. And overall, I mean, that should be supportive for global growth. I mean, of course, it depends on the region specifically, but I think overall, you're going to see lower interest rates across the globe, which should be supportive of better growth, but also should be supportive too a bit for valuations as rates come down. That helps financial assets, largely speaking. So I think net slight positive, and you're going to kind of see a coordinated effort to bring rates down globally.
Two follow-up questions. The first is, what does this mean for the dollar if everyone is lowering rates?
Well, we've seen the dollar shoot up after Trump was elected. I think for now, that's probably the direction we're going to see. Uh, Dave, I don't know if you would disagree with that.
Wouldn't disagree. I mean, I think you're just stating a fact. I think what's a little bit odd, and I think this is true of a lot of Trump's policy pronouncements, is that they tend to be conflicting. And the dollar, I think, is a good example of that. I mean, he wants to get the U.S. trade deficit down meaningfully. To do that with a rising dollar is really tough. And I actually believe that he'd like to see the dollar come down significantly, particularly against the Chinese currency, the renminbi, and also against Japanese yen, because they're two very much export powerhouse countries, and the yen is like 40% undervalued versus the dollar right now. So that can't be making him very happy. So yeah, I think the dollar, short term probably okay. Longer term, I think the dollar goes down.
How do
And
you
I think that's what he
respond?
wants.
Well, how do you respond to the narrative that central banks globally and I guess in the US would only cut rates further if the economy isn't doing well? In other words, there's no reason for them to cut rates with inflation already on a downward trajectory.
Well, I would say that it's not just inflation that's on a downward trajectory. It's economic activity. I think Europe is a mess economically. I mean, Germany is. I mean, you saw the announcements today of their big steel company that's laying off 40% of their workforce. Almost all their automakers are cutting their labor forces drastically. I think the German industrial locomotive that pulled Europe for so many years is in real trouble. France is a mess. Canada, your country, has been hurting at least on a GDP per capita basis. I know immigration's been a big driver of top line GDP numbers, but to the average person, not so much. And actually, the Bank of Canada, I believe, has cut 50 basis points twice. So they're obviously concerned. I think you got a real problem with the housing market up there. I think globally, it's not that great, frankly. But I mean, there are pockets of strength. They tend to be more in the developing world. So I think in general, these Western central banks are going to be in an easing mode. And I think the reason the Fed might not is because the U.S. economy does look stronger on a relative basis. And I also don't think there's any love lost at all, putting it mildly, between Jerome Powell and Donald Trump. And so
Okay.
I don't think you're going to see the enabling that's been going on in the past by the
Jeff,
central bank.
just to follow up on what David said, if the U.S. is looking relatively stronger versus its peers, will that translate to outperformance of U.S. markets relative to other G7 markets or perhaps even emerging markets?
Great question. I'm not so sure it will. You have a record valuation gap right now with the U.S. Stock market and international stock markets. Now, I think there are pockets of value within U.S. equities that should do well. Large cap value looks reasonable. Small caps and mid caps both trade cheap relative to, say, the S&P 500. So I think some of the cheaper markets in the US should outperform, but I also think international is set up well. To Dave's point, on a longer term basis, if the dollar weakens, I think you will have some outperformance from international markets versus the US that look exceptionally cheap, one of the cheapest valuation discounts of all time. If you just look at the broad international index versus the US, I think on the income side, emerging market bonds also look very attractive relative to US bonds. And the US bond market, there's lots of different areas that we invest in. We are not touching long-term treasuries, but there are some attractive areas on the US income side that I'm sure we'll talk about.
Mm-hmm.
So the bond market's not created equally, I guess I would say.
Okay. Moving on here. This is a slide that I think we're all familiar with, the rising deficit level of the US. And by the way, it's projected that under Trump, the deficit level would increase, although he has made efforts to curb this with the introduction of DOGE, the Department of Government Efficiency. Will that efficiency commission or initiative, whatever you want to call it, will that actually help reduce the deficit going forward?
Kind of
Well,
doubt it. Sorry, go ahead, Dave.
And just for context, Vivek Ramaswamy said on the Tucker Carlson show that he wants to cut the government by 75%.
Okay, well, let's just think about that for a second. Let's say they're successful, and I think there's a lot of reasons to believe that they're not going to be successful because so many of these expenditures are kind of locked in, whether it's military spending, which is tough to cut, with all the geopolitical tensions. Obviously, the interest costs are going ballistic and will continue to as the debt rolls over at higher and higher rates. Just the locked in Medicare, Social Security, Medicaid, those are tough to cut. But let's just assume that that does happen, that there's a $2 trillion reduction, which I believe would be about a 30% cut in government spending, a lot less than what you just mentioned that Vivek said. But what would that do to the economy? And I think that's look at what happened in Argentina, where they really were forced to do draconian cuts, and they had just a horrific recession. And so that's, I mean, the amount of pain I think that you'd have to endure to get to that is almost unacceptable from an American standpoint, particularly when we have this, what I think is kind of an illusion of prosperity and that everything's great, at least for the wealthier consumers. So I just think this gets back to these some of these cross-purpose things that are going on with the proposed Trump policies. Right now the market's very optimistic that they're going to be pulled off flawlessly. I have my doubts, and I think Jeff does too.
Jeff, I've noticed a correlation, not a causation, perhaps causation. We'll let you discuss this between the deficit level over the last decade and the inflation rate. Can you comment on that?
Well, yeah, I think the more the government spends, the more that's going to cause inflation. I think if you look at inflation expectations, they've headed significantly higher over the last 3 or 4 months, particularly over the last 2 months. So I think we're going to be in an environment that has higher inflation. From over the last 20 years, inflation ran around 2%, a little below 2%. I think we're going to be in that 2 to 3 range. And I think to get our debt to GDP under control, I think that's the logical path forward, or the likely path forward is that inflation is going to run slightly higher than interest rates, and the government's going to try to inflate away the debt. So yes, I think the deficit's going to remain wide, and I think inflation is going to run higher, and it's going to be an interesting dynamic. And I think the hope is you can keep inflation higher than interest rates and bring debt to GDP down through higher growth and lower rates relative to inflation. Whether that can get pulled off, we'll see.
Wait, just to clarify what you said, inflation higher than interest rates. Are you talking about the Fed funds rate? Because currently the Fed funds rate is below 2.5, which is what the inflation
Correct.
rate is. That's
Yeah,
I think
I think the longer term Fed funds rate is going to be below where it is today, and so yeah, I think that they're going to try to do that. Whether they can pull it off, we'll see. But yes, I think inflation, in the 3% range, 2 to 3% range, and if interest rates stay low, perhaps you can bring the debt to GDP down that way. I mean, debt to GDP has come down with nominal GDP running at a pretty fast clip over the last couple of years.
Yeah. Well,
David, I'd like to, if I could just
Sure.
chime in here a little bit on the inflation thing, because I think it's another case of tale of two. I think there's tale of two inflation rates. There's the official government inflation rate, which may not be misleading intentionally. I know a lot of people feel differently, but for sure it's been heavily influenced by goods disinflation, even deflation, basically since the summer of 2022. Like natural gas prices coming down from 10 to 3 and oil prices from 130 or whatever to 70. And a lot of other commodity prices, look at lumber deflating. If you look at the services sector inflation, it is a different story. And I would argue that's probably more meaningful for a lot of people. And that's running more if you look at the Fed's own data over the last 3 months on an annualized basis, it's running about 4.4%. And my friend Vincent Delavard has this, what he calls the haircut inflation index, just measuring what's happening to the price of haircuts. He thinks that's one of the purest service sector inflation measures there is. And that's running, ironically, almost exactly the same, 4.5. So I think if people do get their fur up a bit when they hear these official government statistics that seem a lot lower than their actual cost of living.
Okay, what happens when the inflation rate exceeds the Fed funds rate? So this happened in 2021. If I were just to scroll out a little bit, this is the S&P 500. Inflation was on the rise after COVID, and we know what happened in 2022. This was a period when inflation was above the Fed funds rate. The markets really didn't like that. Is that indicative of what would happen again? I'll let whoever.
Well, it could be. I think what was different. I think it was different back then was that the interest rates were very, very low. The Fed fund rate was basically zero as inflation started to go postal. So Powell had to catch up very quickly. That's why it was one of the most aggressive rate hiking cycles ever. So that created a tremendous amount of stress on financial markets. He's in a much better place today. I mean, even if you accepted inflation running at 4, at least he's got the Fed funds rate a little bit above that. So I don't think you'd have, the severe trauma that you had back then because of inflation The Fed was so far behind the curve that they really had to play aggressive catch up. So I don't think that's a risk anymore. I think, frankly, I mean, where I worry is that we talked about this briefly, that there's, for a good reason. I mean, Jeff gave you all these solid data points about why the U.S. economy looks just fine, but there's some underlying indications of weakness that I'm seeing flare up again, and maybe it's just a passing thing. But I guess I would say that with all these, there's a lot of policy shifts that are going to be happening early in 2025, especially tariffs. I mean, you saw the tariffs on your country, Canada, and Mexico that were announced today, and then, what if there are 60% tariffs on China? I mean, the possibility of some destabilizing policies that cause, an economic, at least a gut check, at least some kind of a fear that perhaps we are going to have a harder landing. That's just not in the market right now. Whenever something's not in the market, whenever the consensus is so convinced of a certain viewpoint, I think it's good to examine the other side.
Jeff, what's your response to that? Tariffs, how will they impact the markets?
Well, I think tariffs would cause lower growth. I think tariffs would cause higher inflation. I hope that there's some thought behind placing these tariffs. I would hope it's just not across the board 10% for everything. I would hope it's not just 60% on everything from China.
I think that's what it sounds like. Whether or not they'll
that's what it sounds like. It likely would be, but I think Trump also does care very much about where the S&P 500 is trading, and I think he might put some thought behind where the tariffs are placed, and I hope there's more thought than just across the board. But I think if it is that way, you're going to see lower growth and higher inflation, and that's going to be a negative growth policy, and one that could cause some serious strain on markets and the U.S. economy.
Lower growth meaning lower earnings as well?
Maybe. You have the offset of deregulation. You have lower tax rates. I think corporate tax rates are going to come down. So I don't know. You would think that small caps in the U.S. that are more U.S. focused maybe see an earnings boost there relative to international. So I think there's some offsets, but maybe lower earnings growth. Net just on that alone.
Okay, David, I'd like to flip to you for this next slide. P ratios extending. How does this fit into your bubble 3.0 thesis?
Well, I think it's bubble 4.0, David.
Oh, we're around 4 now. I lost count. I'm sorry.
I know. You gotta have almost an abacus or a calculator to keep track of all these bubbles that we've had. And to that point, I think one of the reasons that it's been so bubbly over the last 15 years is for most of those 15 years, the Fed funds rate has been negative. So you've had a tremendously stimulative monetary policies, other than that period where the Fed did react to inflation exploding. And of course, then in the last 5 years, tremendous fiscal stimulus, which continues. And you had an image up here a little while ago about 6.5% deficit to GDP, which is about $2 trillion. That's just unbelievable in what is supposedly a healthy economy. And I guess I would challenge the victory dance a little bit on the soft landing by saying, but what if you adjust for this tremendous deficit spending? What would GDP growth be without that if it was more of a normal level? I think you could say the same things about earnings, because deficit spending to this degree is also very supportive of earnings.
Well, so there's no immediate downside then to deficit spending, because that's, like you said, it's propping on markets.
Well, I don't know. I mean, this is again where I think you get into these kind of contradictory Trump policies. I mean, he's talking about lowering the corporate tax rate to 15%. He's talking about no tax on tips, no tax on Social Security, no tax on overtime. I mean, those are all things that are going to increase the federal deficit at the same time that you've got the Doge guys trying to cut it by $2 trillion. So some of these things are really working at cross purposes with each other. But I guess in terms of multiples, I mean, it's clearly one of the most expensive stock markets ever. By some measures, it's not. And this makes it look like the PE isn't as bad as it was. I guess that would have been 2021 during the kind of the crescendo of bubble 3.0. Mm-hmm. But I mean, really, if you look at things like price to sales or the Buffett indicator, which is market cap to GDP, I mean, we're at record levels. So but for sure, it's an extremely expensive market that is assuming a lot of things are going to go right, and maybe they will. And maybe the government will continue to create all this tremendous liquidity. But I do think, particularly when it comes to the Fed, the Fed's got a very different mindset now with Trump in office. As you know, that he's talking about having a shadow Fed chairman in there to keep an eye on Powell. That Powell's got to test that.
Jeff, over to you now. The key is to identify at which level it becomes a serious problem. Like it's already above the pre-Great Financial Crisis. If you just take a look at the blue line trailing PE, one could argue it could extend further before it becomes a serious problem. I'll let you comment on that.
Well, it's, valuation, and there's a chart coming up on this, is a very useful indicator when you look at long-term forward-looking returns. It's much less useful when you try to predict a 1-year kind of estimate based on value, 1-year return forecast based on returns. Mm-hmm. So I think at this point, at 21 and a half times, 2025 earnings, we're at a point where forward-looking returns on the S&P 500 are, in my opinion, for sure going to be lower than they have been the last 15 years. Long-term returns on equities are around 10%. We've been running closer to 15%. So logically, when you're starting at 21 and a half times forward earnings, the returns are going to be lower. I think JP Morgan ran a chart that showed that forward-looking returns on stocks are going to be in that 2 to 3% range. I would think they're more in the mid-single digits. I think looking forward, equity returns are going to be lower based on the starting point of valuation, which makes, high quality bonds where you're getting 5.5 pretty attractive relative to, buying large cap growth at 35 times earnings.
I think this is partly why Buffett is record cash level here, $325 billion cash. The consensus explanation for this is that he believes it's expensive for some of the reasons you just stated. So the question is, if not stocks, then where? Cash? You stated short-term bonds, cash equivalents. What's the alternative?
Yeah, I think T-bills at 4.5 makes sense, but we're big fans of mortgage-backed securities, which are actually trading at quite wide spreads relative to pure treasuries. So you can get in that 5.5% range with mortgage-backed securities. I think closer to 5.5, right, Jeff, with something like MTBA.
Yeah.
And that is an ETF that's very very liquid, and so yes. And then if you go to a little bit little racier variety, then you can get into the mortgage REITs, and in that case, you can get double-digit yields. Now these are basically leveraged plays, and the leverage is often 6-7 to 1, but they do a lot of hedging, and they've done a pretty good job of being able to navigate through difficult interest rate cycles. But one of the best times for them is if you get relatively stable long-term rates and falling short-term rates, which we have sort of had for the last year or so. That can be good for them. And then, I think it was before we started recording, we talked about the pipelines, because I know a lot of your audience owns things like Enterprise Products, which is the leading master limited partnership midstream energy pipeline operator, and those still yield 6.5%. And they've actually had a major breakout here recently. They raise their distribution almost every quarter, not just every year, but every quarter. I think the only time they didn't was during the COVID lockdowns. So there's definitely areas to go. And I think that actually for a lot of your viewers who've made a tremendous amount of money in the stock market, if they're willing to cash in some of their gains, and we would encourage them, if they have IRA accounts, which a lot of high net worth people do, they have both a taxable account and a tax deferred account, take your gains in your IRA and reallocate to some of these things where you can reduce risk, get higher cash flow, and avoid the tax liability.
Interesting. So, by the way, this is the chart that you were talking about earlier, Jeff. The future valuations, or future looking earnings rather, and valuations. So, like my manager at my first job told me, valuations are a poor indicator of short-term price movement. So that's what this chart is supposed to show: cyclicality of the price of the stock markets. And then here you have strong equity markets through October to the end of the year, and then the following year down 21%. I'm curious as to why you averaged 2020, 18, and 2014.
Well, if you go to the previous chart, David, these were the years that were similar up years through October. You had 2013, 2017, 2019, 2021, 2023, and 2024. And our point on this chart last month was, if you are up, in the 15 to 20% range through October, you generally finish higher. And in every one of these instances, you finished higher to end the year. So momentum is a strong, is very strong right now. And, right now the trend is higher for stocks, and we think we finish the year higher. At least I do. I think Dave would agree with that, David Hay. Now the next, and the reason why on the next chart to show the next 4 years would be the years following those strong years. So 2014, 2018, 2020, and 2022, the average peak to trough pullback was 21.5% after those very strong up years. 2014 didn't have a big pullback, but that was earlier in the cycle. That was also when valuation was much cheaper. 2018 had that nasty sell-off in December. I remember trading on Christmas, the day before Christmas, when we were buying up as much as we could during that sell-off. I think Dave's laughing because he remembers that. We were
Sure do.
kind of chatting around the holidays, trying to do as much buying as we possibly could. 2020 was when the market fell 30%.
Well, let me just stop you there. How did you decide to buy more rather than just let the market slide?
In 2018?
Yeah.
Well, the
Well, I
market
think we
was
both.
extremely oversold.
It
Sorry.
was very oversold, and I think we believed that Powell was likely to blink. He really did a 180 almost overnight back in December of 2018, saying that he was on autopilot in terms of rate increases, and all of a sudden he was like, well, maybe not. And so it seemed to us like kind of a green light. In 2022 during COVID, when the market actually got down about 38% from peak to trough in about a month. It was also the Fed, because that's when the Fed said that they were going to step in and start buying corporate bonds, which was unprecedented, something that we'd actually anticipated and were told we were crazy because it was illegal, but they managed to do it anyway. And so once they announced that, I mean, we really went heavy. We got pretty lucky and almost hitting the very bottom. But anyway, this market has been going for a long time.
When something like that happens, how do you make the decision as to whether or not, or how do you evaluate if something is oversold, if the markets are oversold, like you said, or if it's the beginning of a larger bear market?
Well, one of the best tip-offs that it's a good time to buy is when it's quite clear that there's a global margin call going on. And actually, we even got a little bit of that in this last August. People forget when the yen carry trade blew up. And it was quite clear that margin calls were going out around the world. That for sure was happening in 2020, maybe a little less so in 2018. But when you get to these situations where there's just panic in the market, and you see that there's the fear and greed type of indexes out there, when you see tremendous amounts of fear and people are afraid to buy anything. And, Jim Cramer is getting out his rosary beads on CNBC. I mean, that's the kind of stuff that we look for. But we also, I mean, rarely do we ever go all in. I think probably the closest we came to going all in was in March of 2020 during COVID.
Mm-hmm. Yeah, and I would say, David, we didn't buy all at the low. We kind of proportionally bought on the way down.
Yeah.
Generally, what we say is small correction, small buy, larger correction, larger buy. And then, we look at a lot of things like RSI that was really oversold. You look at discounts on closed-end funds. You had some record discounts, not only on equity closed-end funds, but bond and emerging market closed-end funds. As Dave mentioned, the bull-bear spread was extremely bearish at the time. So a lot of indicators that, over a long time frame point to really good buying opportunities, not to mention valuation had come down to a reasonable level, or a level at least that we felt warranted a good amount of buying at that point.
Let's flip over to the last part of the presentation, which starts with this slide here. David,
that's what I inserted. Yeah, so
this is from the October, the October 19th issue. The envy of the world is the American economy.
Right.
Yeah, what do you have to say about this slide?
Well, I would just say consider the source. I mean, as you know, The Economist is wrong so often when they make these really bold cover images. And they've done that with oil when oil's been down. They did it with the stock market when it was raging during the tech bubble. And it's a constant pattern with The Economist. So I worry that this is the kind of thing that happens as you get closer to a top in the U.S. stock market.
Yeah.
And frankly, I think the reason, so what we're looking at next is why, we've talked about this for a minute already, but why is the U.S. economy the envy of the world? It's because we have been running deficits that are way beyond any of our Western counterparts. And this showed that in the 3 months leading up to October, federal outlays, so this is not the deficit per se, but it's outlays, they rose drastically. And if you were a little bit of a conspiracy theorist, you would say, well, gee, that's kind of coincidental leading right up to the election. Was the government really trying to make things look as good as they could for the Biden administration to help uh, uh, Vice President Harris? And I don't know if that was the case, but that's certainly what happened. And I would also say it's certainly true that since the election, Jay Powell's had a rather dramatic change of heart without really a lot of economic data to justify that. So this was actually in the month of October, federal outlays rose by $500 billion in that 1 month alone. I mean, it was like a crescendo of government spending.
Yeah.
But regardless, what this really tells us is that so much of this American exceptionalism, if you will, has been a function of government red ink. And that's just clearly not sustainable. And I think Donald Trump's going to have to deal with that.
Wait a minute. Let me just flip over to the stock market one more time. I wonder if this is a good leading indicator for market performance. I'm just observing something here. So if we go back to in 2021 or early 2022, outlays fell. So it decreased. 2022 was followed by a bear market. Outlays picked up late 2022, followed by a return of the bull market in 2023. I don't know if there's a correlation there. I'll let you comment on that.
Oh, it looks kind of that way, and it's kind of logical. I mean, this is a way of measuring liquidity. It's not the only one.
Yeah.
But when there's big liquidity infusions, the market tends to do well. So that's another thing that happened as well leading up to the election is the reverse repo account. The Fed's reverse repo account, which was like $2 trillion, has been drawn down to almost nothing. So that was a huge amount of money that also got dumped into the system. And I guess that's another reason why I'd be a little bit leery about next year is a lot of these liquidity injections that were so massive look to be unsustainable and might get reversed. So I'd say it's again a buyer beware type of situation.
Do you expect, let's go back to this. Do you expect this to change with Scott Bessent being appointed Treasury Secretary? He has a 3-3-3 policy. Part of the three is a 3% deficit, right? So
that's not a lot from 6.5.
Yeah. So I mean, I don't know if that means less government spending. Do you think they'll accomplish that goal?
Well, that's why I was saying that you've got these conflicting forces at work between this. I mean, during the election, it was almost a bidding war between Harris and Trump, who was going to give away more money to the taxpayers. So and I think some of those campaign promises are going to be hard to back away from. So then you have to cut the rest of spending. If there's a lot of waste out there, then you cut it. No doubt there is. But I don't think it's going to happen overnight. I think this is going to be a process. I think that Elon Musk might find out it's easier to recapture rockets from outer space than it is to try to control the spending of the federal bureaucracy.
Okay. We'll see how that goes. The economy now relies entirely on foreign net savings. What do you mean by this chart?
This is a Lacey Hunt special. And it really, so one of the things that we tend to forget about is not just the federal deficit, but also the trade deficit. And between the two, so we already said the budget deficit is about 6.5% minus. There's about another 5% minus of trade deficit, maybe 4, but it's somewhere running a combined 10 to 11% range. And so we're basically having to rely on foreign savings because there's not enough domestic savings to be able to finance that. Now, it has happened before. You can see that during the financial crisis, we got into the situation, but that's when you were in a really severe recession, the worst recession since the 1930s. We're in expansion, supposedly, and we're in a net negative national savings situation. That's not good. Mm-hmm. It's just, I mean, there's so many things about this that are not sustainable, and I'd say this is one of the most salient.
Well, by the way, let's take a look at, I know this is not directly related to the chart you show, but I'm curious to examine personal savings rate from the consumer side. So the savings rate has skyrocketed during COVID when people couldn't spend money, went down, and now it's hovering above 5.5%, which is consistent with, I guess, the historical average. Are you expecting the savings rate to change going into 2025 and beyond?
I don't think so. I don't see what would be a big catalyst for it. Overall, I've seen the personal savings, and I can't quite see the right edge of that, but it's been trending down from the peak. So I don't think it goes a lot lower than where it is currently. What I think is interesting is because this kind of relates to the national savings thing, but so there's the profit formula. It's old. I think it's the Levy-Kalecki profit formula. Basically, what it means is that when the consumer is dis-savings and the government is dis-savings, which the government is doing in a massive way, what that does is it really inflates corporate profits. And frankly, David, this is something I don't hear anybody talking about. It really frustrates me. Actually, there was an op-ed in the Financial Times a couple of weeks ago where the author brought this up. But this idea is how much of U.S. corporate profits are being goosed by particularly the government deficit spending. And I don't know the exact number. I don't know that anybody does, but I think it's significant. And again, it's not sustainable.
Okay. And then finally, I'd like to touch on this chart here, mortgage spreads. So if you look at the top panel here, the MBS spreads have been pretty trading range bound. Triple B corporate spreads minus MBS negative territory. What is this signaling?
Well, it just shows mortgage-backed securities are very attractive today. The spread or the compensation over treasuries you're getting is near a record. You look at corporate bond yield less than treasuries, and treasuries are government-backed. Or sorry, the mortgage-backed securities are government-backed. You can see historically that corporate bonds may yield 2 to 3% more during recessionary times, but today you're able to, again, buy mortgage-backed securities yielding over 5%, which are higher than corporate bonds, which with much less risk. So that's one of the areas of the income markets we think are really attractive right now, as Dave mentioned. And I think it's just a different playbook, David, than it's been for bonds. From 1999 to 2019, you could just buy the Barclays Ag, you could buy long-term treasuries, and you made 5 to 6%. There's a negative correlation to stocks over that time frame. So when stocks went down, bonds went up. It protected your portfolio. If you look over the last 5 years, the Barclays Ag is down. TLT, I think, is down about 20% over that time frame. So it's a completely different playbook today than it's been in the past. And you want to have different positions in your income portfolios. You want to have inflation beneficiaries like midstream energy securities. You want to incorporate things like mortgage-backed securities with moderate durations. Dave mentioned emerging market debt earlier, which looks very attractive to us. So you really don't want to be passive on, I'm kind of going beyond mortgage spreads, apologies for this, but it's a subject I'm passionate about, is you really don't want to be passive on the income side. And there's some big problems with being passive on the income side. If you think about market cap weighted equity indexes, generally the largest positions are the best companies, or the companies with the largest set of earnings, or the companies with strong earnings but very strong earnings growth. Someone's applying a value to those large companies. The largest weightings in the bond indexes generally are the companies that issue the most amount of debt. We, generally speaking, if you look at the corporate bond indexes, don't buy the biggest issuers in those indexes because the bonds don't look very attractive. So it's a very different playbook. There's a lot of areas on the income side you want to be invested in that are not in the index. And quite frankly, the index has been a horrible investment over the last 5 years.
Well, that leads me to my final question. We'll end off of this note. So we already talked about portfolio allocation and opportunities for investors given your macro outlook. We talked about your fixed income portfolios that have done very well relative to the index. Generally speaking, when somebody is trying to construct a fixed income portfolio for themselves, when they're looking for yield, what are some of the common mistakes that you've seen?
Well, first of all, they try to do it themselves. Sorry, like Jeff said, I mean, this is an area where a manager can really add value. It's very tough to do that. I think people on their own can do a decent job on the equity side or simply index. But maybe they're really good at picking the next NVIDIA, whatever. But it's really tough in the income area and the bond area. I mean, for one thing, there's just lack of visibility, lack of liquidity, lack of ability to execute very effectively. So it's and I think what people tend to do is to default to the funds. And with the funds, you tend to get something that's an open-end maturity. A fund doesn't come due with very few exceptions. It's just out there. It's going to constantly roll over its maturities. And we have bullet maturities. So if we buy a bond that's going to come due in 2030, we're going to get our money back in 2030, even if interest rates are substantially higher. So Jeff, I know you would like to add on to that, so I'll stop there.
No, I think you made all points that I was going to bring up. And It's also a very bifurcated market. When you're going out to buy General Motors stock, you go buy GM equity. There's, probably 50 different GM bonds you could buy. There's the GM credit bonds. There's the preferred position as well. There are fixed bonds. There's floating rate bonds. There's bonds that are fixed to floating rate. There's short maturities. There's long maturities. And all of that stuff you need to change within your portfolio given the environment. When rates are very low, you want to hold a low duration, generally speaking. When rates move up significantly, you want to extend duration. When credit spreads are tight, you want to lighten up on the junkier part of the credit market. When corporate bond spreads widen out significantly, you want to add risk to those. You want to increase the junk in your portfolio. We tend to do high quality, high yield. But there's so many different areas of the income market, and you really need to pivot. And it has not worked to just own the index.
Final question, I'll let you go. Speaking of duration, do you hedge against duration risk?
No, we just generally adjust it based on the environment. Today, we're a moderate duration. We don't like the end of the curve, but we do like the middle of the curve. You can get, 5.5% with a pretty high quality portfolio. If the Fed cuts rates, those maturities become shorter. Then you start benchmarking against short-term rates. You then can get a little bit of capital appreciation on top of that. You then can sell those bonds and buy more bonds in the intermediate part of the curve. So generally, no, we don't hedge our duration risk, but we adjust it based on the environment.
Well, with the yield curve steepening, has that changed your outlook at all and your positioning?
No, I mean, we've liked the belly of the curve for the last 2 or 3 years. It's been a really good place to be invested in this last 18 months. We do add a little bit of duration when the long end moves up and bonds do get oversold. When rates move up significantly, we'll add some duration. When they move back down, maybe we'll take some duration off the table. But there's going to be a lot of treasury instruments. We're not really owning hardly any long-term treasuries. We own very few long-term bonds in general, unless the yield's, very, very attractive with a high coupon that shortens the duration of that bond.
Okay. David, anything to add?
Well, I guess I would just say that I agree with everything that Jeff said. I am starting to wonder, I know we touched on this earlier, if maybe there's a tactical trading opportunity coming up here with longer treasuries. We're not committed to that yet. We're just kind of examining that. But I will say some of this economic data that's come out lately, including the Chicago Fed National Financial Index or Activity Index, which is just terrible right now. I mean, it looks like we're in a recession. And that's one of the broadest measures of the U.S. economy. So, I look at all this data and I get, as Jeff knows, I'm constantly saying, if you're not confused, you really don't understand the situation. And there are just all these powerful cross currents working against each other. And I'm not sure which way they're going to go, but I guess my basic point is we're keeping an eye on, there could be a time to buy some long-term treasuries, at least on a tactical basis. But again, the problem is in the next recession, what's going to happen to the deficit? The deficit's going to go just absolutely through the roof, and that's going to push long-term interest rates likely higher since we're so reliant on foreign buyers, and those foreign buyers are not showing up.
Appreciate your analysis. Thank you, gentlemen. Where can we learn more from you and Evergreen Gavekal?
Go ahead, Jeff.
Well, we have a website, Evergreen Gavekal. On there, there's a client compatibility survey. You can click schedule a consultation. If you want to learn more, we'd be happy to analyze your portfolio, give a recommendation. We have a lot of people that would love to speak with anyone that's interested in learning more.
Great. Thank you.
And as you know, David, I write a newsletter, The Haymaker, at Substack. So your Haymaker Substack, I don't think the ad is actually in there, but there's a decent amount of free content there. And so please check us out.
Yep, I'll put the links down below. Thank you very much for watching. Don't forget to like and subscribe. And thank you both, Jeff and David.
Thank you, David.
Take care for now.